Hello, I'm Kristen Duffy, and welcome to Sector Vector, the show where we dissect the U.S. equity market to look at how the different sectors are performing. Last week marked the fourth straight week where U.S. equities fell, despite closing up on Friday. This comes as investors got to grip with the prospect of a second coronavirus wave emerging in Europe and political instability in the U.S. The S&P 500 closed up on Friday, but steep losses on Monday and Wednesday dragged down the benchmark index, resulting in a 0.6 decline for the week. The broad sell-off at the start of last week was sparked by rising infections in Europe, renewed lockdown measures, poor Eurozone data, and caution from policymakers. Political tension was another cause, with ongoing stalemate gripping U.S. legislators over the contents of a new stimulus package. Fed officials, including Chairman Jay Powell, amplified their calls for additional fiscal support and warned of a much more gloomy outlook without it. That said, there does appear to be split opinion in the markets on whether this is just a healthy correction or a pivot towards the bear market. Looking at the key movers, following 3 weeks of decline in the tech component of the S&P 500 rose 2.13%. Rather than any fundamental driver, the emerging narrative is that a lot of firms took profit on tech stocks at the start of September in favor of cyclical exposure as part of a quarterly asset allocation adjustments. That doesn't mean that tech stocks are expected to roll over, but investors want less exposure, so are happy to re-enter with smaller positions at lower levels. On Friday, FanMag shares rose across the board. This is certainly something we saw looking at our proprietary Trackstar data, where institutional investors paid a lot of attention to Tesla, Apple, Zoom, and Amazon. Large-cap growth equity and technology ETFs were popular too. Inflation is a hot topic right now, with the Fed open to letting it overshoot its 2% target in order to make up for earlier in the year when it fell to almost zero. And oil prices are generally seen as being linked to inflation, as higher prices lead to a rise in inflation by increasing the cost of inputs. But last week was horrendous for the S&P 500 energy sector, which declined 8.6%. This was led by the decision by OPEC Plus to unwind its voluntary production cuts and comments from the OPEC Secretary General, who suggested that the group is in no rush to further reduce supply. Interestingly, Trackstar data shows that as the energy sector bled out, Wall Street professionals paid a lot of attention to two solar energy companies, Sunworks Inc. and SPI Energy, as well as carbon renewable fuel company Pacific Ethanol. A counterbalance to this, however, is news that new orders for key U.S.-made capital goods increased more than expected in August, and demand for the prior month was stronger than previously estimated. The data suggested a rebound in business spending on equipment was underway after a prolonged slump, and saw S&P 500 consumer staples closing the week up 1.23%. It was a fast-moving week in the real estate sector too, which closed down 2.14% on the week. Trading on Monday started with a gap lower, but following data on Thursday showing the most new home sales since September 2006, the sector rallied and closed the week trading at Friday's highs. However, the broader fear is that if a stimulus package can't be agreed before the November election, then Q3's gains, and with it inflation, could reverse. That's all we have time for this week, but before you make any investment decisions, always make sure you do your own due diligence. Safe trading!